Sunil Subramaniam, good morning. Thank you for joining us. Sunil, last week markets were supposed to go down. Election outcome is not something what markets were entirely excited about. The change of guard at RBI has set cat amongst the pigeon on the way RBI autonomy could be compromised. Why on the earth are markets going higher? I mean, with this kind of a news flow, if I put two and two together, market should have been down.
Yeah, I think there are three reasons for this, Nikunj. The first is that the market actually went down when the opinion polls and the exit polls came out, right? That was the initial of the market. But what happened was, because it was a Friday, Saturday, Sunday, Monday, a long weekend, the market actually got a chance to think through the whole exercise of the election. And then when the actual election results came out, what they found was that a small swing of vote share led to a large drop in the seat share. And they felt that local state related issues which led to that swing, this gives a chance for the Modi government and the Modi Amit Shah political formation to actually take corrective action and swing that small percentage back. So I think though there was about 4.5% swing in votes away, I think another 2% was the differential max between Congress and BJP. So I think the market felt that with the next 6 months, knowing that these states are at the knife edge, the BJP could easily do necessary actions from a political front to win that back. So I think the market realized that while the seat level thing was shocking, the actual vote share thing was not as dramatically different. Second, Mr. Shaktikanta Das, as the RBI governor, was one of those people in the government who championed the demonetization as well as the GST reform. So he's in that sense a pro-government person. And I think in the short run, the market actually welcomed the fact that the government and RBI are not going to be so much at loggerheads, and that there would be that room for the RBI's actions to be supportive to the extent that the macro doesn't get severely impacted, of course, right, to the government's action. So I think market is reading going beyond just a numerical seat share and taking a perspective on what are the BJP's chances for the elections. And I think they are not too worried about the BJP coming back, though perhaps it will now come back in more of an NDA avatar rather than a pure BJP, single party government.
Sunil, but we can talk about opinion poll positioning, we can talk about what the markets are in terms of technicals. That's a short-term factor. And if markets indeed have bounced back because of the positioning, then I'm afraid this rally is not going to sustain, because ultimately global cues, high valuations and a visible slowdown in earnings recovery is going to puncture us back again.
There are two things there. One is a global slowdown actually means that there would be more money flow directed towards emerging markets. In India, on a relative growth perspective, still stands head and shoulders above the rest of the world in terms of GDP growth rates. So a global slowdown is not necessarily bad news for the markets. It's bad news for the economies in the longer run. I agree with you that, in terms of the export, that could get delayed. But in terms of money flow, liquidity flow, an easing of growth in the US markets would actually mean more liquidity coming in year one. Second is, one of the other reasons why this happened is that these continued strong SIP flow into the domestic markets. I think it's close just shy of 8,000 crores. Means that domestic fund managers are sitting on money. Now for them to take a call on the market means they actually move into cash, which is not what they want to do. So the long-term money which is coming in through SIPs is going to continue to get deployed independent of this short-term volatility. So that being said, Nikunj, even if the short-term political scenario doesn't come as positive as the market is expecting, I would say that the flow of money will still keep going buying long-term growth stocks in the country, and that would keep the broader market in a relatively lesser volatile situation, even if the short-term turns to be adverse.
Sunil, the popular trade in the market right now is corporate banks, and whichever brokerage or, just about any expert that you speak with believe that it is corporate banks which are going to lead the growth higher. Do you believe, though, that it is a well-discovered story, or do you think that there is significant amount of headroom from the current levels as well? Because most of these stocks have already run up quite a fair bit.
I don't think the run-up is still got a lot of room to grow. I don't think they are anywhere near close to even moderate valuations. I think the valuation story is still on the downside. You can still pick it up. And we are strong believers in this story for the reason that there was an overcorrection on the corporate bank space or because of the NPA news. But I think a systematic series of provisionings and bringing down the profits means that a lot of the book and the potential losses are already covered for. Second is the extent of resolution will mean that even in those where they have written it off, even some resolution, even if they say 50% recovery is there, it straight goes to the bottom line. So the impact on the EPS, the market just cannot estimate on the bounce back in the EPS. That is the second part. Third is within corporate banks, that what has gone up is the private sector corporate banks. People still have comfort that the private sector. The public sector corporate banking has been hammered big time and yet to recover from a market sentiment perspective. But as the resolution in terms of the mergers of these banks and the fact that they are going to be the primary lenders on the infra cycle recovery, you will see that a lot more public sector corporate banks would participate in the rally. So overall, I'm saying there is still enough space and juice in this for this to be the next big driver of the stock market in the next 2 to 3 years.
Okay, Sunil, how would you be, rebalancing your exposure towards financials? Would you continue to keep it with the private sector banks? Are you going to, and especially the retail-oriented themes, or are you going to move into corporate banks and also spot opportunities in the beaten down NBFC names?
Okay, so the three separate aspects there. Okay, see, private sector corporate banks, we've already been bullish, we continue accumulating, right? Private sector retail banks, right, we feel in the short run are a very good pick because of the short-term volatility, the fact that in an election year consumption goes up and that consumption needs financing, and the absence of NBFCs from this space means that private sector retail corporate banks are ideally positioned to go and grab the retail credit boom as we see coming over the next 6 months. So yes, private sector retail oriented banks will continue to be good safety picks from our portfolio. On NBFCs, we are very, very careful because for us, the asset liability mismatch is a key thing to watch for. So short-term NBFCs, which are not running huge mismatches between using 90-day CP to finance 5-year and 10-year loans, those we would be wary of. But those which are in the short-term financing bit, right? I think those kind of stocks are still good value bets because they have the ability to pass on the fact that the costs for the NBFC sector have risen irretrievably post the ILFS crisis. Those companies which can pass it on to the consumer are the ones which are going to be able to retain their margins. So while we are underweight the NBFC in relative to benchmark, we will still look for good picks there based on these filters that I just spoke about. On public sector corporate banks, right, we would look at probably those banks where the merger exercise is done so that we can have a look at what the balance sheet is going to be. Whereas those which are not yet been affected by the merger cycle will be a little bit cautious because paradoxically, a bad bank through the merger actually becomes a better bank, but a good bank in that merger process actually could be a worsening. So it's a very risky pick to pick banks which have not yet been involved in a merger cycle in the PSU space. So I would tread with caution and observe the actions of the government over the next few months before taking my call.
Sunil, as a house you've run high exposure in auto ancillary. Is it time to revisit that? Because domestic auto sales are getting punctured. Globally, JLR is in a mess. BMW has given a profit warning. So is it time to reorient what couple of years ago looked like a structural theme and a made in India bet? Now purely demand supply equations have changed, and also, I mean, this entire concept of made in India, you can selectively argue, but overall has not met with a lot of success.
I agree with your assessment that the basis on which we were picking those, that all the things have played out. But we continue to stay bullish on auto and auto ancillaries, because we believe that in the short run, in the election run-up, automobile vehicle demand will continue to be strong. We will believe the rising GDP per capita and the reasons are going to continue to lead to a top-line growth. Auto ancillaries, we believe, have got not only a domestic play, they also have got an export-oriented play, and I think the cost element that will help them to beef it up. So while some of the things that you said about the past did not come true, we are not still lost confidence in the auto and auto ancillary space, and we continue to remain overweight to the benchmark and will hold on to our positions there.
Sunil, for next 12 months, do you think are we in for a flat return, negative return, or a positive return?
Next 12 months, I would say single-digit, close to high single-digit returns from the market is what I think is a more reasonable expectation.
Do you think we should not worry about this election connection? You know, we tend to think that in the run-up to the election, markets will remain volatile and then that will be a 15-20% swing event. I think we should approach elections and the election and the market connection with some degree of, not with a lot of caution. I mean, election is an important event. It could have small short-term ramifications, but nothing changes in the big picture.
I agree with you fully. And if anything, the recent election and the way the markets have reacted only reinforced that thought process. I agree that for a long-term investor, the election should be just one more systematic allocation investment. It should not affect his asset allocation, should not affect the long-term nature of his investment, nor should he, worry about it in terms of his existing portfolio. I am fully with you on that, Nikunj. I think the election is just an event, which is an event along with the Trump tweets, along with oil prices and along with everything else. These are all factors which are net will even out over the long run, right? One positive abroad, one positive, one negative India will even out. So I think that for a long-term investor, the right way is to have a diversified portfolio with the right equity debt mix, and within equity the right large cap, mid cap, small cap mix, and you stick to that association and continue systematically allocating to that, whether you do it through SIP or you keep putting in variable amounts every month. I think that is what will pay rewards in the long run, independent of election results going which way.
Okay, Sunil, great to have you on the show and glad that you could join us from Singapore as well today at such short notice.